In this video, we're going to be performing a deep dive on 3M Company's dividend safety. To begin, let's talk about 3M's business model. 3M sells more than 60,000 products that are used every day in homes, hospitals, office buildings, and schools around the world. 3M employs more than 90,000 people and serves customers in more than 200 companies. 3M is composed of 5 separate businesses. The industrial division produces tapes, abrasives, adhesives, and supply chain management software and solutions, among others. The safety and graphics segment manufactures personal protective gear and security products. The healthcare segment supplies medical and surgical products, as well as drug delivery systems to customers. The electronic and energy division produces fibers and circuits with the goal of using renewable energy sources while reducing costs. Lastly, the consumer division sells office supplies, home improvement products, protective materials, and stationery. 3M is a well-known dividend stock because of its compelling track record of dividend growth. With 59 years of consecutive dividend increases, 3M is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. In fact, 3M's dividend history qualifies it to be a member of the Dividend Aristocrats Index more than twice over. With more than 50 years of dividend growth, 3M is not just a dividend aristocrat but also a dividend king, an even more exclusive group of stocks with 5 decades of consecutive dividend increases. Looking ahead, 3M's above-average dividend yield has led some investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss 3M's dividend safety in the context of the company's current earnings. When 3M announced its third quarter financial results on October 23rd, the company reported that it generated earnings per share of $2.58 in the 3-month reporting period. For context, 3M currently pays a quarterly dividend of $1.36 per share, which implies a payout ratio of just 53% in the most recent quarter. Using earnings, 3M's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare 3M's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2018, 3M generated $4.2 billion of cash from operating activities and spent $1.0 billion on capital expenditures for free cash flow of $3.2 billion. 3M distributed $2.4 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 75%. Using free cash flow, our conclusion is the same. 3M's dividend appears very safe for the foreseeable future, although its payout ratio using free cash flow is noticeably higher than the earnings per share equivalent. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze 3M's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. 3M's performance during this time period is shown here. 3M's earnings per share declined by 19% peak to trough during the economic contraction of 2007 to 2009. Importantly, though, the company's earnings still covered its dividend payments, and 3M continued its multi-decade streak of consecutive dividend increases. With that in mind, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess 3M's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. Through the first 9 months of fiscal 2018, 3M generated $255 million of interest expense and had $14.8 billion of debt outstanding for a weighted average interest rate of 2.3%. The following image shows how changes to 3M's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, 3M's weighted average interest rate would need to rise to approximately the 10% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that 3M's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on 3M's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, Visit our website at www.suredividend.com.